Market sentiment has been highly unstable this week, mainly due to the sharp shifts in the news regarding the introduction and cancellation of the US trade tariffs. So now, traders are forced to monitor Donald Trump's political and economic moves almost in real time. However, today market attention was drawn to the US jobs report. Meanwhile, Fed Reserve policymakers are assessing the potential impact of Donald Trump's policies on the future interest rate decisions. For example, Lori Logan from the Dallas Fed is ready to keep interest rates unchanged for quite a long time. Philip Jefferson, the Fed Reserve Vice Chair, shares the same view. He believes that the US economy is starting the year in the strong position and that there is no need to rush with the next rate cut. According to the FEDWATCH tool on a Friday morning, the probability that the Fed Reserve will cut the key interest rate at its meeting on March 19 was only 14.5%. The US dollar's moderate retreat below 108 points suggests that it's not pleased with this stability. Of course, Trump's storm suited the greenback with a bottom, but even here, it seems a calm has settled in. According to US Treasury Secretary Scott Bessent, the president will not pressure the Fed Reserve or demand a rate cut from the policymakers. Has Trump changed his mind, postponed the decision? Who knows? In other words, the United States needs a strong dollar that dominates over other currencies. However, executive dollar strengthening will push inflation higher, and that's something Donald Trump does not want. After all, one of his main campaign promises was deflation, a decline in consumer inflation. While politicians are busy balancing between desire and reality, the euro managed to enter correction and even slightly strengthen. However, Germany's economy, which today released an industrial production report, dealt a blow to the single currency. The data turned out to be a disaster. Instead of a moderate decline of around 1.9%, the German industry shrank by 3.7% in December from a year ago, and this marks its worst performance since July last year. By the end of the week, the euro initially retraced its aid gains, recovering to Monday's levels, where the euro-dollar pair had dropped after Donald Trump's tariff announcements. However, the instrument quickly fell back under strong bearish pressure, which pushed the price toward the key technical support zone of 1.0350 to 1.0360. If this support zone fails, the next target range will be 1.0290 and 1.0300. However, in case of a sharp decline, analysts recommend buying the euro. A strong bullish breakout above 1.0545 would signal a reversal of the bearish trend. For now, bulls will first need to break through the technical resistance at 1.0445 to confirm any upward momentum. But today's January NONFARM payrolls report seems to have snatched away this opportunity for the euro. With the dollar buyers regaining control, the euro-dollar pair has hit fresh lows near 1.0350. The number of jobs in the US public and private sectors, excluding agriculture, rose by 143,000 in January. The unemployment rate dropped to 4%. Wage growth accelerated from 3.9% to 4.1%. There is no clear direction in the oil market today. On the one hand, Saudi Arabia announced a sharp price increase for its crude oil. For Asia, prices will rise by $2.4 per barrel. For Europe and the Mediterranean, the increase will be $3.2 per barrel. But on the other hand, weekly US oil inventory reports recorded another sharp surge in reserves, while forecasts expected to rise over around 2 billion barrels. The actual figure came in at 8.66 billion barrels. As a result, the upward and downward pressures level off each other. Another key factor is the ongoing US-China tariff war. Unlike Canada and Mexico, where A reconciliatory conversation took place. No such dialogue has occurred between the United States and China. It means that the situation could drag on, affecting not only China's economy but also the global economy. The uncertainty surrounding global trade could weaken demand for crude oil. As a result, despite a moderate increase within the daily range of $74.10 to $75.10 per barrel, Brent crude is now heading for its third consecutive weekly decline. The Russian ruble is going through a seesaw today on the daily chart. The dollar-ruble pair briefly spiked to nearly 98, only to drop back just as quickly to 97. This may be linked to the US embassy's refusal to postpone sanctions on the Serbia's oil industry for 90 days. The company is jointly owned by Gazprom Neft and the Gazprom. It's also possible that a large transaction on the exchange impacted currency rates. Despite the Russian ruble strengthening in January, experts share a bearish forecast for the ruble. Foreign currency sales for Russian oil companies remain consistently high. The 7% decline in January does not appear critical at this stage. However, if this trend intensifies, its negative impact on the financial system will increase. By the end of 2025, analysts estimate that the dollar-ruble pair could reach 110, and the yuan-ruble pair could rise to 14.4. So that's all for today. Subscribe to our channel and follow news with us, and see you soon.